And now we turn your attention to big movers on Wall Street. Jenny Horne, host of Next Gen Investing, is joining us. And let's start off with the big rally that we're seeing in MongoDB this morning.
Yeah, MongoDB, a name that was in need of some of this upside, perhaps, because we have been relatively catalyst-like, but it's also been a fairly muted right now overall software and technology space. Hardware has really been our standout of the earnings period thus far, but all things considered, jumping pretty substantially, as you can see there from the chart. I mean, we're up over 30% this morning after the software company did report second quarter results easily that exceeded forecasts. They really came at a time when we're struggling to see this traction hold, at least throughout this year. Again, similar to a lot of these enterprise stocks, but they did say they earned about $1 a share on an adjusted basis. That marked almost a 43% improvement from last year. Sales also rose about 24% on a year-over-year basis. They touted a lot of this momentum, though, for their subscription database software. Subscription-based revenue actually increased 23% to $572 million, well ahead of forecasts. And they did say that many of their recently added customers are building AI applications, thus underscoring how their value proposition is really resonating in this AI era and why they're emerging as a key component of the AI infrastructure stack. They did guide for sales now of roughly $589 million based on the midpoint of its given range. Prior to these results, though, they had been expecting around $582 million for their October ending quarter. So that was ahead, definitely at the midpoint. They did also list more than 50,000 users for their database software, which does include offerings like Atlas subscription software, which is designed across various cloud platforms. But their ability to harness this AI excitement saw, a more than 200% stock rally from late November of 2022 through then February of 24. But they've since seen some disappointment. Shares have fallen about 13% from where we were just 12 months ago. And again, software stocks have really struggled this year. It's been pretty wide felt across every type of software exposed names, where we see not only these outsized moves post earnings, but mostly they've been a repricing to the downside. So I think encouraging for a name that has been fairly lackluster on the year, obviously lower year to date, well off of 52-week highs, that we are seeing such a substantial move because, yeah, we were needing to break out of this recent downtrend that we've seen from a range perspective. So a nice pop today. Can't argue with a 30% plus move.
Yeah, and look, are these cloud-based software as a service, is demand back for tech overall, too. Mm-hmm. Look at, these great numbers, 30% upside today, and incredible. And I did see Wedbush reiterated the outperform rating with a $300 target. Even with this move, it's at $280, so still thinks it has room to the upside. Any final thought here on MongoDB?
Yeah, I think that anytime you have commentary from management, saying that this opportunity is massive, they use really great language to say that there is going to be still substantial positive impact to their financials going forward. But as you mentioned, the street takeaways have been fairly optimistic. I've seen nothing but price target raises, at least so far this morning, as D.A. Davidson did keep a buy, raised its price target to $325, Rosenblatt $305, as well as Wedbush with a $300 price target, as you mentioned. Truist, another one with a $330 price target. So as far as conviction goes, actually was pretty strong going into this report, but at least we have numbers that now match a lot of the optimism from that sell side.
Let's get to Okta, because this is such a different picture than the last earnings report where we saw a big gap down for the stock. In this case, we're seeing it move higher after its report.
Yeah, May quarter numbers were clearly disappointing, and we've also been in a pretty sizable repricing ever since. So again, this was another one where yesterday, previewing this name, we were like, we need to break out of this recent just sort of lackluster neutral trend. I will say, to Okta's credit, it's up almost 15% on the year, but lower still, about 6% on a 12-month basis, and off of those highs that we did see right before their May quarter report by about 28%. So today's move also fairly optimistic, as we are seeing, overall a solid second quarter. Analysts had been largely bullish into this print, but their CEO did raise their forecast as economic conditions they cited were better than they thought. So a nice rally this morning. They did give that guidance previously that was reflecting ongoing macro trends, but they said, yeah, the results basically speak for themselves. U.S. government customers, though, are being more careful about now signing up for deals after President Trump did unveil the Department of Government Efficiency back in January. So they did say, well, they saw some contract restructuring with civilian agencies and some of the delays in their procurement processes. Renewals across all of their federal really spending were actually quite strong, reflecting then the massive critical nature of their solutions. Their net retention rate, which is key, of course, to gauge existing customers, came to around 106% in the quarter. That was unchanged from about 3 months ago. And they did also now call for around 74 to 75 cents a share in adjusted earnings. That was at the midpoint, exactly what the street had been expecting, on now revenue of around 728 to 730 million. That was well ahead of the 723 million previously expected. And they did bump up their fiscal 2026 forecast, but again, no longer factoring in this tone of caution due to improving economics. And all that to be said, I mean, I think that that's hugely encouraging if you want to have a read on the rest of the tech and software space, especially as we go into a very critical announcement from Nvidia today, because right now the concern over government spending, is it going to affect companies? Is it going to weigh on growth? I think you have a company saying, hey, it was better than feared, and we could see some upside as a result, which is pretty encouraging.
Yeah, and look, I love that you mentioned Nvidia again, because I think that is #1 story today. Everybody's clearly waiting, and they expect some good things there. And most of the guests I speak with still think AI is got a lot of room to run. Final thought?
I mean, I think that those believers of this, I mean, you talk about some of these targets for the market opportunity and the trillions of dollars. Like, I know Dan Ives has said we're in the early innings still of this AI narrative. I think that does speak to the names that are continuing to dominate. It hasn't been as widespread or wide felt necessarily, but I do still think if you look at like the critical applications that some of these companies are expecting to really fulfill, I mean, there still needs to be autonomous driving. There still needs to be further iterations of GP and CPUs. All that to be said, I mean, there's still definitely lots of room for improvement and growth. It's just a matter of timing some of these dips, which has been, I think, the painful part, because again, it hasn't been widespread. These software stocks, for example, have been very much just stuck. So at least today is a nice catalyst, no doubt about it. And I'm sure tomorrow is when we get all those market maker moves priced in on the heels of course, Nvidia.
Okay, Jenny Horne, great to see you.